Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing AcuityAds stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. AcuityAds is a technology company that enables advertisers to connect with audiences across digital advertising campaigns from a single platform. Its headquarters are in Toronto, with offices throughout Canada, the US, Europe, and Latin America. The company's newest product is Illumin. This offers planning, buying, and real-time intelligence from one platform. With proprietary artificial intelligence, Illumin brings unique programming capabilities to close the gap between advertising planning and execution. We're going to look at the ticker that trades on the Toronto Stock Exchange. All the numbers in this video are in Canadian dollars. The company also trades on the pink sheets in the United States. The ticker is ACUIF. Let's get started with the model. This is a small cap company, 1.6 billion market cap. They're trading at $31 a share and they have 53 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow every year. Net income is a profit and loss on the income statement. It's revenue minus expenses. And they also have negative net income every year. Revenue is the sales for the company, and that's growing each year, which is good, from 58 million to 115 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Then below that is their gross profit. That's the difference between those two numbers. And the company does have growing gross profit each year. It doubled from 2017. Below that is operating expenses. Depreciation is an example of an operating expense. Then below that is operating income. So the company has negative operating income every year. Below that is the interest they pay in their debt. Then there's other income and expenses. Other income and expenses are usually non-cash gains and losses that get passed through onto the income statement. Then below that is pre-tax income, then their taxes. So they do have negative net income every year. They did have their best number in the trailing 12 months at negative 2.6 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they do have negative free cash flow every year. Since the company has negative free cash flow, it needs money from somewhere to run its business. It's been issuing capital stock, 13 million in 2017, 4 million in 2018, and 8 million in 2019. In 2017, it issued 18 million of debt, paid down 14 million, so it added 4 million of debt. In 2018, it added 10 million. In 2019 and the trailing 12 months, it didn't add any new debt. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow, you don't have much of a business. And this company has started generating positive operating cash flow in 2019 and a lot more in the trailing 12 months. You can think of operating cash flow as net income converted to cash because net income is your accounting profit and loss. There's non-cash items on the income statement. The way you calculate operating cash flow, you start with net income, then you have to add back the depreciation of 8.5 million. Depreciation is a non-cash expense that brings down your net income, but you have to add it back on the CFO section. They also had 1.3 million in stock-based compensation. Even though the company reported a $2.6 million loss, they actually generated over $7 million of operating cash flow. They did have negative free cash flow because they're investing back into their business to grow it. Let's look at a capital structure. 16 million of equity, 27 million of debt. So they're 36% equity, 64% debt. Their net debt is 20 million and their WACC is 21%. and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $1.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1 billion. We divide that by 53 million shares. And we get a calculated stock price of $19. They're trading at $31, so they're trading at a 62% premium. It's a sell according to the model. Simply Wall Street values the company at $7, so they're saying it's even more overvalued than me. You cannot use a traditional discounted cash flow model for a company that has negative free cash flow because their valuation will come out negative. So I had to look at analyst estimates, and I also looked at the competitors' numbers to try to figure out their future estimates. I was a little aggressive with their growth, but based off of what I read in their 10K, this is what I predict. Of course, anything can happen. The company can never have growth. Alternatively, it can have even greater growth than this. The stock price for a company like this is not based off of their financial information because the stock price would be zero. They haven't made any money. Investors are looking towards the future of the company. They're not looking towards the past. Investors feel the company's worth $31 today based off of their expected future value. That's where you as the investor have to try to figure out how much they're worth. You can see the stock was pretty flat for a few years, but it's really been driven up the past few weeks. This company has a really high beta, 2.43, so the stock moves 2.5 times the market. The stock has gone up 1,600% in the past 52 weeks, while the S&P 500 went up only 17%. The low was 72 cents, the high was 31.45. And the stock is trading well above its 50-day and 200-day moving average. About 1 million shares are traded each day on this stock, and of the 53 million shares outstanding, 31 million are on float. Only 12% are held by institutions, and 1.5% of the shares are shorted. FMR is the biggest shareholder at 10.5%, and then a bunch of individuals who are connected to the company own stock as well. Let's look at their financial ratios. The average PE in the market's 10, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 14.2. Investors are paying $14 for $1 revenue. Price to book is stock price over book value per share. They're at 105. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have 16 million of equity, 3 million of tangible equity, because they have 12.5 million of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity. They have negative net income, so they have negative ROE. Current ratio is current assets over current liabilities. They can just cover their current liabilities with their current assets. And their current assets are 7.5 million of cash and 38 million of receivables. So the company will likely need more debt or equity financing to run their business over the next 12 months because they did have negative free cash flow and they only have 2 million of working capital. So they're short $1 million. But it looks like the company may have positive free cash flow in 2021. I'm just basing that off their growth from the past few years. The best way to look at ratios to compare them to similar companies, I've done videos of 13 companies in the same industry as Acuity, and this company is worse than average in every single ratio. They are a small company and they're growing. They have a terrible PE. Their price to sales isn't so bad, it's only 14. A terrible price to book. They do have a current ratio above 1, which is good. Negative ROE because they still have negative net income. They do have a lot of debt relative to their equity. And they're a small company, only 1.6 billion market cap. So to summarize, I do have them trading at a 62% premium, but this company has a lot of exciting products in the works. This is definitely a risky investment. That's why they call it investing. Greater risk, greater reward. I rank their free cash flows 1 out of 11 because they're negative every year. I rank their revenue 6 out of 10. It's pretty small, but it is growing every year, which is good. And I rank their ratios 1 out of 10. They have really bad ratios. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.